Do you want to buy another property but don't have the cash for a down payment? Or maybe you want to pay down debt or raise money for a renovation. Recently, I had to find a creative solution to buy another property, and you're about to hear how I did it. Now, I do want to stress that not all lenders and banks are the same. You should definitely talk to quite a few of them and see what they can do to help you. I end up working with Daniel Halvorsen at LoanPeople to do my financing, and he is going to join us on this video to talk about how I did it and how you can too. Daniel actually helped me tap into 75% of the appraised value of my home in order to buy another property. I purchased the other property on an investor loan, and we will discuss all of this today. Thanks so much for joining today. It's an honor to have you on this call, and you are the person that I work with when I did my financing. So I wanted to share with my group here a little bit about what we did. But I thought what we could do is start off by kind of defining the options people have with their property when they're looking at tapping into cash. Because obviously, I did a cash out refi, right? But there are other options. Do you want to maybe talk through what the options are?
Yeah. So, I think that what is probably most prevalent that people are most familiar with is just doing a cash out refinance, which is paying off your existing loan and taking out a new loan for a higher dollar amount. And, historically, that's probably the most prevalent in the current rate environment. Obviously, we came off of low interest rates for a sustained period of time. So for people that maybe already have a low mortgage rate right now, that may not want to touch a 2.5 or 3 or 4% interest rate to then take out a 6% mortgage rate. So, and home equity loans are a good option if somebody maybe has a low rate and they want to borrow, a separate amount and keep their current loan intact. So those have become more prevalent, and the home equity loans have always been a vehicle, at least for quite some time, to access additional equity in your property. But I would say that they are maybe a little bit more in favor in the current rate environment in a lot of cases if somebody already has a mortgage, relative to if they don't have a mortgage, then obviously we may look at things a little bit different.
So you got the cash out refi, the HELOC, home equity line of credit. Is there anything else that people should be thinking about?
Yeah, there's also, so a home equity line of credit is just what it sounds like. You take out a loan and you have access to use that credit line for a period of time. It could be a few years, it could be 10 years, and you pay interest on what you have drawn during your draw period. And those rates are variable. So for somebody that maybe isn't as comfortable with a variable rate loan, there are closed-end home equity loans, which essentially you just take the full amount of money at once and you pay it off over the remaining term at the prevailing interest rate. So for somebody that maybe has a specific use for the money, they want to use it all right away and they want certainty around what their payments are going to be, then a fixed rate home equity loan is just another kind of vehicle to allow you to pull some money out once again without necessarily having to touch your existing mortgage if you already have a loan in place.
Mm-hmm. Yeah, so that would make sense for people that maybe they have a really great rate and let's say it's a 3.5% or something awesome, right? They don't want to touch that, but they need to access a little bit of cash out of the house, right? And so you would do a HELOC.
Correct.
But with a refi, the good rate goes away, right? It
That's right.
completely gets deleted. You're starting again with a whole new mortgage, right?
That's
Which is
correct.
probably going to be a higher percentage to be able to do this anyway. Yeah.
Correct. Yeah, and I would say just one comment on that. A lot of times people are very enticed by the rate they have right now, but if somebody wants to take out a significant amount of equity and the amount they want to take out is greater than what they owe on their existing mortgage balance, it's also helpful to look and say, okay, if we combine your 3% mortgage rate with a 7 or 8% home equity line of credit or home equity loan, what is your blended rate between those two loans? And could you do better just doing a cash out refi, even though you're giving up a little piece at a lower interest rate? What's the total overall rate you're going to pay combined? So I would just say that as a disclaimer. if you have a low rate right now, but you have a tremendous amount of equity and you want to repurpose that equity for one reason or another, look at the whole picture, look at the blended interest rate. That's not tremendously difficult to do, and don't get hung up on, well, I don't want to lose this little piece of loan that I've got at this lower rate if doing a cash out refi and having one loan truly would be a lower total interest rate than what you're paying on your current loan.
Hmm. Yeah. Now, the cash that comes out of the house, and we're going to talk about how much you can get in a minute, but you don't have to put it towards property, but you can, right? There is no real limit to what you can spend it on.
Yeah, I would say in pretty much just about any scenario I can think of, if you take out a home equity loan or do a cash out refi, that money is yours. So it would be a very rare scenario that a lender would scrutinize or question how you're going to use that money. So you can use that money, generally speaking, however you would like.
Yeah. Okay. So let's get into what the qualifications might be for, let's say, a refi like I did. What are the things people need to be prepared for in terms of bank statements and all of that good stuff?
Well, I think holistically, if somebody comes and says they want to refi or they want to take equity out of their home, for most people, they would obviously prefer to get the lowest rate they can. So we kind of would go through a range of options and say, if we do traditional income qualifying loan, what is the rate? What are the parameters? Does that work? If the answer to that is yes, then that may be the scenario that you want to go down. If there's maybe more creative situations where maybe somebody's recently retired and they've got a lot of assets, but they don't show a lot of income, or it's an investment property and maybe it's just kind of a tricky situation from an income qualifying perspective. There are options where you're not looking at in the borrower's traditional income sources. You're looking at the property as the source of income. So what's the payment relative to how much the property produces in rental income? So from there, there's kind of a web of kind of like a chart we use in our minds to say, okay, well, if this, then this. There are loan types where you can just use assets as the basis of repayment. So even without necessarily having to liquidate or touch assets, those can be used for qualifying. And then there are also, all the way down to non-income qualifying loans. So it really, it really just kind of depends on the situation and the parameters. But I would say, generally speaking, we would start at the what's the most favorable rate scenario, and then we would kind of work our way down based on where that conversation goes.
Hmm. Yeah, I think the non-income qualifying loans, we watch the marketing of the banks, right? And we see that they're usually just marketing the conventional. A lot of people don't know that there are other loan types that are not about how much you earn on a W-2, right? And so
Correct.
it's good, I think for this call, it's good to highlight that because I have a lot of investors that watch this and they want to know like how could they tap an investment property or something like that. And these are kind of what I call more creative ways, which is why I say, if you are looking at doing financing, talk to a lot of people, talk to Danielle, because there are other ways of doing it that your regular bank is probably, they may know about, they may not know about, or wouldn't you agree, Daniel, that you just need to do your research?
Yeah, and a lot of those other more creative products are what are called non-QM, which stands for non-qualified mortgage. So it just doesn't check all the boxes of the Consumer Financial Protection Bureau's definition of a qualified mortgage, which would be a loan that you would sell to Fannie Mae or Freddie Mac or HUD or VA, wherever that loan may go. But non-QM loans have increased considerably in popularity from when they came on the scene, and probably the 2013, 14, 15 ranges when we really started to see them kind of take hold. And then since then, they've really grown in popularity. But these mortgages are securitized and sold on Wall Street. And Wall Street, some of the big players there are interested in these loans, and there's been a strong push for those for different types of products to enter the market. So as far as from a lender like ourselves, there's a greater access to those types of products than really we've ever seen before. And there's a lot of creative and unique things that we could do that 6, 7, 8 years ago were just maybe not available.
Yeah, very interesting. So, yeah, great idea to just go through all the scenarios based on your personal situation and just see what makes sense for a solution.
Without a doubt. I mean, there's generally a way to get it done, and then it's just a matter of evaluating, do the terms make sense for what you as a consumer are looking to accomplish. But there's probably a path through some vehicle or loan program that we could give options of, well, we could do it this way. And then, like I said, just a matter of evaluating, okay, does this make sense based on what I'm trying to accomplish?
Yeah, absolutely. Well, walk us through the process of the refi because obviously there's an appraiser involved. It's kind of like you're selling your house to the bank essentially, right? Or reselling it.
Correct. Yeah, and most refinances, if you do traditional income qualifying, you have to show ability to repay, which means pay stubs or W-2s or tax returns, however your income is derived. If you're looking at an investment property, like I said, you could look at what's called a DSCR loan, which we may touch on a little bit further here later, but that's really just evaluating the property as the basis of repayment. So the more that the home rents for relative to what the mortgage payment will be, the more favorable the loan terms will be, not just interest rate, but how much can I borrow? How much can I pull out of the property? And in most cases, an appraisal is going to be required. Obviously, that's the bank's justification or the lender's justification of how much they're going to make the loan for.
Mm-hmm. Absolutely. So, and you will see the appraisal, right? So as you're cashing out, you will see the appraisal come. You'll see what they come back with. Now, in my case, I didn't necessarily agree with what they said. I wanted, obviously, I thought it was worth more, and I definitely wanted to go up to as much as I could get out of it, which I believe is 75% of the appraised value, right?
Yeah, in some loan types, you could take that up to maybe 80%. Home equity loans, you could sometimes take that to 90, 95, maybe even 100% with some lenders. So it really depends, but on traditional cash out refi, it's probably going to be between 75 and 80%, depending on, is this a primary residence or is this a second home or investment property? Those will kind of dictate how much or how high that loan to value ratio will go.
Mm-hmm. Mm-hmm.
And it's oftentimes it's a little convoluted for consumers and sometimes for us as well when it comes to appraisals, especially on refis. What you could sell your property for is maybe not always what an appraisal is going to come in at. Sometimes they come in lower than expected, which obviously we never want, but it happens. And sometimes it comes in a little bit higher than maybe somebody may anticipate. But it's a little bit more it's a little bit more difficult to project. If you're purchasing a home, you've got a purchase contract. Obviously, a buyer's agreed to pay for the home for a certain price. The seller's agreed to sell for a certain price. So that alone is justification of market value. Whereas if you've got a refinance transaction, there's obviously no seller or buyer with an agreed upon price. So then it's just a little bit, I guess there is a little bit more that's left to opinion in that case from an appraisal perspective.
Yeah, especially when you've got a unique property. Which I have a property with two houses on it, which was hard for them to come up with comps on, especially in this market where we're not seeing a ton of sales in that with that type of property. So it became I guess personally like disappointing, but we still were able to do the 75% and move that money, in my case, over to a different house, which I really, really wanted. So it worked out.
Yeah, well, fortunately, that's still worked out. If an appraisal comes in and maybe the value isn't quite what's expected, there is a reconsideration of value process that allows the consumer, with the help of the lender, to submit information, supply the appraiser with additional sales or maybe inaccuracies that they found within the appraisal report. So you have an opportunity to go back and say, hey, we'd like you to reconsider this appraisal based on certain components and information that we want to provide to the appraiser.
hmm Absolutely. So once the appraiser comes in, they write the report. Their report goes to you, just like a regular loan, right?
That's correct.
And then basically you're saying, well, what percentage do you want at that point, right, of this number?
That's right.
Yeah. And then in terms of getting the cash, I mean, what's the process? to that. And I know I submitted a lot of bank statements during this whole process, but tell us a little bit more what's involved so people know.
Yeah, I mean, for a refi, if it's income qualifying, we're going to request all the same information that we would as if you were purchasing the home because that's just documenting your ability to repay and verification of income. For asset statements, in some cases, if you're refinancing primary residences, you may not have to show assets. If you're refinancing an investment property, a second home, there may be some cases where you have to show, hey, I have money in reserves, which is not money that you're required to use for the transaction, but money that's the lender wants to verify that you have some level of savings in the event that you have vacancies on your rental property or for one reason or another want to document reserves. So in some cases, asset statements will be required for accounts that maybe have nothing to do with the transaction other than to show you have some level of savings that's available to you. But most refinance transactions can be completed within 30 days, I think, barring unique circumstances. 2 to 4 weeks is probably about average time to be able to start and close on a refinance transaction. Similar to a purchase, it's a lot of the same paperwork, but obviously you don't have the logistics of there's a seller on the other side and we have to coordinate with what they have going on. In this case, obviously, we're just communicating with the consumer in this case, and generally speaking, we can move as quickly as they want to go for the most part.
Mhm. Now, what was interesting in my case is that you had two loans to work on, my sale and my purchase. And you promised me, well, you said it would be 30 days for either of them. And we did it both at the same time, which was, if anyone's thinking about actually doing this and buying another property, this is kind of what you'll be doing. But you made it happen. It was kind of like we were dealing with two different closing statements. And can you talk a little bit about that? Because I think that's what people would do if they really were putting that money into property.
Yeah, and a lot of times, if somebody wants to use the money for a specific purpose, such as buying another property, they don't want to close on the loan and have the funds available from a refi until they've identified how they want to use that money, so they're not paying, higher mortgage payments or more interest, and they don't have a purpose for that money. So it's pretty often that you would run two transactions concurrently, which I tell people the benefit of that is hopefully we're just supplying the same paperwork for both loans, right? So if you're doing paperwork, you might as well do it once and close on two loans.
Yeah.
But logistically, obviously, we've got to time out. The refi has to close first. If it's a primary residence, is there then a rescission period of 3 days that you have to wait before you can access the money? And then coordinating that around the schedule of when we need to close on the new property as well. But really, logistically, most times things align there as long as you don't hit a speed bump that maybe wasn't foreseen. It's generally you're able to kind of engineer a soft landing to be able to close on both at the same time and kind of thread the needle with that.
Hmm. Yeah. Well, I thought it was pretty impressive that you were able to kind of time them both at the same time. And in actual fact, with the cash out, that money just went from one title company to another. So most of it I used in the down payment actually. So it was pretty seamless. Everyone worked together, and I was pleasantly surprised at how it all worked.
Well, that's the goal. That's what we always hope will happen.
Yeah, no, it was good. So let's see. Going back to HELOCs, I see a lot of stuff about HELOCs on YouTube and on different sites, podcasts and things. Some of it's negative, and I just wanted to get your opinion of it. Like, um, I mean, is it a bad idea?
I think it depends on your use case. If you're somebody that wants to take out a HELOC because you'd like to flip properties and you want to get into a property, use that HELOC money to buy it or renovate it and then sell it and pay it down, that's a great vehicle to do something like that. So you're not constantly reborrowing money, right? And paying cost associated with that. I
Mm-hmm.
think that where HELOCs can become a little bit of um, maybe a concern for some people is if you take the HELOC and then you use that to then take on more debt elsewhere, right? And especially if you're taking out a HELOC and let's say you do a 30-year loan but you have that 10-year draw period. Well, for the first 10 years, you're only paying interest. The required payments are generally interest only. So if you take out 100,000 at an 8% interest rate, you're paying just the minimum interest payment. And then when you get to the end of year 10, if you've fully drawn that equity loan and you've only been paying the minimum interest payment, well, now you switch from a interest only payment to essentially a fully amortizing principal and interest payment on a 20-year term because you only have 20 years left to pay that loan off. So there could be some payment shock there, and that would be a scenario where we would say, hey, if we're not going to responsibly use this money, then those payments will go up, and that could put you in a worse financial position down the road. And then obviously, there's a little uncertainty of what could happen with interest rates. I'd argue if you're taking out a HELOC today, it's probably better odds over the course of the next few years that those rates maybe would come down. Conversely, if you took out a home equity loan in 2020, you may have gotten a 3 or 3.5% home equity loan, and then you watch that rate rise to 8.5%. Obviously, that payment goes up considerably. So being conscious of the fact that interest rates can change on that, and you maybe shouldn't take out a home equity loan on a property if it's variable and you need that rate to be 3% to afford those payments. Well, it's unlikely over a long period of time that that rate's going to remain low, obviously, just with economic cycles and what typically happens with interest rates over time. So that would be maybe the biggest scenario where we would say, hey, maybe a variable rate equity line of credit, maybe that wouldn't be the best option for you.
Mm-hmm. Okay, that's good to know. Are most HELOCs variable rates?
Most HELOCs are variable rates because they're giving you the lender's giving you a line of credit option. They want to be able to take advantage of increases in interest rates, right? To give you that flexibility and functionality. Whereas a closed-end equity loan, you're taking all the money up front and you're repaying it in fixed installments. So you may find a little bit better of an interest rate on a fixed rate home equity loan because there's a little bit less, risk as far as what's that balance going to be? What are you doing with that money? So, yeah, generally speaking, I'd say a fixed rate is going to give you a better interest rate than a variable rate.
Mm-hmm. Yeah, I think a variable sounds kind of scary to me. Just trusting, whoever's making the decisions. Yeah, fixed is definitely preferable. Well, I guess I want to talk a little bit about who this is good for because, obviously, we don't want to get into mortgages for the sake of getting into mortgages, and people have different reasons for buying another property. If you're an investor and you want to build your portfolio, this is a way to do that. And also, in my case, I saw a property that I really wanted. I mean, the motivation was high to get this house. I had watched it go in under contract twice, and I didn't want to be seeing it for the third time, missing out on it. So, I was trying to sell my investment property, but at the end of the day, speaking with Daniel, we came up with a solution, meaning I could keep the property, the existing one, and then tap the cash to lock in this new house. But there are some things you should know. Example, I can't sell that other property right now, correct? I have to wait. If I wanted to sell it, not that I do, but you are locked in for a period of time, correct?
Yeah, and especially if you're doing some of the more creative products or a DSCR loan, pretty common with a DSCR loan, you may have a prepayment penalty. And those prepayment penalties can vary. You don't necessarily always have to have one, but you can take a prepayment penalty oftentimes for a lower rate today with a stipulation that some of that interest has to be paid back if you refinance or sell the property during that prepayment penalty period. So typically those will be between 1 and 5 years, and it's either 6 months worth of interest based on the principal balance at that time, or it's a step down where it could be a percentage of the loan amount, and then that steps down gradually over the course of 3, 4, or 5 years.
Hmm.
So prepayment penalties, once again, they have a place. I think when you say prepayment penalty to somebody, they say, wait, that sounds bad, right? But I think there's a place for it. I would argue if you're taking out a loan today, and this is a property that you're buying as a long-term rental, having a 1 year prepayment penalty on that for an eighth or 1/4% lower rate today, probably worth a look because it's unlikely that you'd be refinancing that property in the first year unless interest rates just dramatically change, which you wouldn't typically expect that.
Hmm.
And obviously, if it's a long-term hold, you wouldn't expect to be selling it within a year. So there's a place for it, but I think really just being aware of it, how it works, and what the penalty is, just that having that information so you can evaluate that option is obviously extremely important.
Hmm. What are some other things that when people were thinking about this type of thing that you could miss if you were doing it for the first time?
I think really in terms of
Not that
loan,
you would miss it, but it's just a question that wasn't on the top of my head until I did it the first time, and I did pay the price on another property, getting out of it earlier than what I had agreed to.
I mean, I think the biggest thing is if the lender's quoting you a rate and they're sending you, fee worksheets, or they're not sending you loan estimates, it should be something that they should disclose. Hey, this has a prepayment penalty on it, and this is the prepayment penalty. And you'll obviously get that when you get your loan estimate. But at that point, if you've already agreed to a property and you've already agreed to terms, you may have agreed to terms under the pretense that you get a certain rate to make the numbers work, and now there's a prepayment penalty. But I think it also just goes back to what's your intent with the property and what's your outlook on interest rates. Are you willing to take a higher interest rate today with the opportunity to refinance, or are you somebody that maybe values certainty a little bit more and says, "Hey, I would rather know what my payment's going to be, and not be planning for a refinance." So I think that's really one thing. The other thing, especially with DSCR loans, is there are a number of different ways those can be structured, and there's also what are called no ratio DSCR loans, which means that property could rent for way less than what the mortgage payment is, and the lender doesn't care. But oftentimes, the higher the debt coverage ratio is, the better the interest rate. So if you come to me about to want to buy a property and you say, "Hey, I'd like to put 15% down, and I want to buy this and use it as a long-term rental," well, chances are the rent may not cover the payment at 15% down based on the rate, based on what you're buying, and it could, but as opposed to if you're putting 25 or 30 or 40% down. So if that appraisal comes in and you weren't using a true fair rental value. So if you're using $3,000 for rental income in an area where 2,200 is the prevailing rent, well, now once that appraisal comes in, now, hey, our debt service ratio is lower, your rate is higher. So that's something to be aware of. What are the numbers that we're using for rent? Are we being realistic with that, or are we shooting for the moon and then that comes in lower, and now your rate's a quarter, 0.5% higher? You're paying additional fees for that, and now the numbers don't work how you want them to work. So I think that's the biggest thing with the DSCR loans is, are we being realistic about what it's going to rent for relative to what our mortgage payment's going to be?
Yeah. So yeah, we've just switched into the investor loan. So to be clear for everybody listening, this is not for your primary residence. This is for an investment property. If you're thinking of a short-term rental, if you're thinking of a long-term rental, medium-term rental, that kind of thing, right? Multifamily, potentially, well, up to 4 units, 5 units.
Yeah, up to 4 units is generally residential. We can go higher than that, but then you kind of getting into different terms, down payment rates. So generally 1 to 4 units is kind of the sweet spot for these residential investment property type loans.
Mm-hmm. And then investors like it. Obviously, it's based on the rent schedule, right? The appraiser's perspective of what that rent would be. But what is interesting about this, which I think it's new, is you're also looking at the short-term rental potential, correct? Which when I first did it, you weren't looking at that, but now I guess you look at Air DNA and other things.
That is correct. Yeah, AirDNA is probably the most popular. And really with the DSCR loans, if the property is currently rented, obviously we'll use the current lease. If there's a long-term tenant in it. If there's not a tenant in it at all, or not a long-term tenant, when we order the appraisal as a lender, the appraiser completes an additional step. It's called a rent schedule. And they go out and find comps and say, "Hey, we found two or three rental comps, and this home would rent for approximately $2,200, or, insert number here." So, but the challenge with that for a lot of times with appraisers is, hey, they're really only able to see rental data that is captured in MLS, the multiple listing service. So If I go stick a sign in the ground and somebody calls me and I rent that home out to them for $2,800, well, that can't be captured anywhere. That can't be proven. So we're relying on the rent schedule at that point if it's not currently rented to dictate what is our ratio on the debt service coverage. And then that dictates obviously the terms of the loan. However, using short-term rental income has become much, much easier than it used to be. And if the property already operates as a short-term rental, we can obtain a history of bookings and use that income that the property is already producing. And if it's not, we can use AirDNA for that, which once again, you're at the mercy of what does that data show, right? You may have plans to go in and renovate that property and add an ADU or convert a structure to an ADU, and now your rental income is 25, 30% higher than what AirDNA shows, but we obviously can't prove that at the time that you close. So we're subject to what does this data set say, which may or may not be the most reliable thing in the world. But that's something that we can look at for you before you go down that path if we know that it's going to be a short-term rental. So we could tell you this is what it's going to rent for, and this is maybe how we need to structure the loan based on that information.
Mm-hmm. Yeah, so obviously, the short-term rental rent is higher. I mean, in some cases, double, more than double what it would be on a long-term lease, right? So it can look really favorable in terms of getting a loan for it.
Sure.
I would say that looking at some of the historical data for short-term rentals, I mean, a lot of them, I see the data, they're not actually performing that well for various reasons. There's nothing wrong with the property, perhaps. That could be location, it might not be. It could be just the style of how they've done the furniture. I mean, there's just so many different facets to short-term rentals. But
You're really running a business almost
yeah.
when you have a short-term rental. A long-term rental, much easier concept, right? You probably can only do so much, but short-term rentals, you have this real ability to massively improve your profitability, or in turn, if you do nothing with it, then your returns may be much lower than a house one street over that's performing much better.
Hmm. Let me ask you this one, Daniel. Are you familiar with pad split?
I wouldn't call myself an expert by any means.
They rent room by room, right? And then
Yep.
the income tends to be higher generally than a short-term rental. So that's kind of like the way to really maximize a real estate opportunity. I was just curious how you would do a loan on something like that. Would you consider that like a short-term rental? They're doing like month to month kind of things.
Yeah, I mean, if it's month to month, then you get into is there an established history? Sometimes if there's an existing lease in place, but it's month to month, the lender may not see that as favorable because that could end tomorrow, right? We're writing a loan we would treat it as a long-term rental if there's a lease in place generally.
Okay.
Um, but if everybody's month to month, many investors would say, hey, this doesn't work. They need to be on a long-term lease because what happens if they move out of the property the month after you close?
Hmm.
So there's a little bit there's a little less certainty around that. But I would say in general, the pad split income, no matter what type of loan you're doing, that can be a lot trickier because you've got a four-bedroom house, but you're renting the rooms out. But in all actuality, it's a single family home. So some lenders may look at that and say, hey, we want one lease on this property, or what is going market rent for a true one unit property instead of a property that's maybe been modified to be rented by the room. Although oftentimes people will buy an investment property, they'll enclose a room or they'll make a fourth bedroom and then they will increase the rental income. So it could be a great opportunity, but from a lending perspective, it may not be viewed quite as favorably as is it a is there one long-term tenant in there, or is it a Airbnb type property that we're using? It's a little bit, I guess it's maybe a little bit more of a gray area or just a little more difficult than one of those other two scenarios.
Hmm. Yeah, absolutely. Tell me a little bit about your customers right now. Are they going back to the refi? I mean, how frequently are they? What are you dealing with right now in terms of that versus just writing loans?
Well, I think if you're looking at somebody refinancing their primary residence for the refi market right now, as rates come down, you've got the people that bought in 22, 23, 24. Maybe they could benefit from a rate and term refinance. But if you're looking percentage wise, that's a very low number of mortgages of all of the mortgages that are out
Mhm.
there. Right? So it's
Sure.
a very small subset of people. The cash out refis, I think, are prevalent more so when people have other debt they maybe want to consolidate. They've taken on some other debt. They want to roll that into a lower interest rate via cash out refinance. So that's something that we've seen maybe a little more prevalent on the cash out refinance side. And then we've got a pretty good subset of investors and repeat investors that we work with a good bit, and they're always looking at, I've got this property, I paid cash for this one, and I want to pull cash out of this one to then go take to the next one, or I want to have that home equity loan so that I can buy a property, do the renovations, refinance, go find another one. So with investors, there's oftentimes a kind of a continual, should I be taking equity? And we don't give financial advice, and we don't run projections for people because obviously every situation is different. But one thing that I tend to lean on with people is looking at, what's your cash on cash return when you have a rental property? If I'm making, $500 a month in rental income, but I have $400,000 in equity in this property, I'm making a very low return relative to my equity position. So does it make sense to then repurpose some of that equity, buy another property? Hopefully you've got two properties performing and appreciating at that point. And everybody's situation is different. Some people, maybe they want to buy five rentals, want to pay them all off, and then they want that to be rental income into the future. Well, in that case, it probably doesn't make sense for you to then be refinancing because that's counterintuitive to your goal.
Mhm.
But I think for a lot of investors, they're looking at, how can I acquire as many properties as possible that are rented, that are performing well, that will appreciate in value. And then you start to look at, okay, well, I've got a lot of equity over here. It's not doing anything for me, and I'm not producing a tremendous return on my rental income. So does it make sense to maybe take some equity, do something else with that? Or are there other options? Maybe I sell this property and buy one or two more that are performing better. So it's, we try to give people, hey, this is something I would think about, and then obviously, let them make their decision on what they would like to do.
hmm Yeah, I guess it goes back to, if you're an investor thinking about this, what is your asset class, right? What do you specialize in? Are you in short-term rentals or do you not want to be in short-term rentals? Do you want to do long-term? Because I think that's a different type of investor actually, in general. But also just, what is your long-term goal? Is it to have houses that you've paid off and you're creating income for when you retire, right? Out of that rental income. So everyone's different, or you've got some investors that just kind of want to keep scaling up their portfolio, getting higher and higher class properties. So you got to start somewhere, right? But then keep going to get that great location if that's what you really want.
And also, are you buying for cash flow or are you buying for appreciation? Because oftentimes those are different markets. You may buy something at a higher price point if you're buying for appreciation. You may buy a different property altogether if you're buying specifically for cash flow. So understanding, and obviously you never want to buy a property where you're losing tons of money every month. But understanding what are you buying for is also an important component of what approach should I take, right?
Absolutely. And we were just talking about this earlier, Daniel. A lot of people are focused in and zeroing in on the rate. What's the rate? Where I kind of think of it is if I didn't buy the house that I did buy now, it's going to be worth so much more in the future that I may not be able to buy it. So that was how I was thinking about the rate, because yes, it was a bit higher than a general conventional loan, right? But being able to secure it now and ultimately getting it and then having the chance to refi later, let's say the rates go down, was better to me than thinking about inflation and what it might cost in 5, 10 years' time. What are your
Yeah, I
thoughts?
mean, I think real estate is the ultimate get rich slow, and you listen to Bigger Pockets or some of these other podcasts and listen to somebody that started with buying two properties. Now they have 100 doors, and you say, okay, well, how can I sprint to that point, right? And it's generally speaking, that's a full-time job. If you've already got a full-time job and you want to invest in real estate on the side, you're probably not going to be the person that's going out and doing syndications and getting to 100 doors as fast as possible. But it's a get rich slow thing. If I buy property today, we've got 80 something years of data that says real estate prices generally go up. So in 5 years and 10 years, those numbers are going to look different. And I always tell people, sometimes people will come to me and they say, well, I've got a aunt, uncle, brother, friend who's bought this property and they're making $2,000 a month net on rental income. Well, it probably didn't look that way when they bought that property 15 years ago, right? Those returns can look better over time in terms of your monthly cash flow because rents generally only go up. They don't generally go down. And as inflation happens and rents go up, you've got the power of the 30-year fixed rate over here where your mortgage is a fixed cost, but your rents are going up. So the longer you hold that property, generally speaking, the better your returns will be.
Absolutely. Great point. Anything else that you would like to share today with the group?
I think that the last talking points I would have back to kind of the point on creative loan options. There are a lot of different programs out there where maybe traditional income qualifying isn't exactly the best scenario for you. There are a number of different ways we can use assets. We can use rental income. We can stack different types of income to help get a loan through. So really, I would say working with a lender that maybe is well versed in that, and also just supply them all the information, right? Give them everything and let them put the pieces of the puzzle together. Don't not send them the asset statement that has a bunch of money in it because you're not using it for the transaction, because that could be another variable where we say, okay, well, now we can do this. You can buy investment properties just using assets as income. So if you wanted to buy a property and for whatever reason, it's maybe not going to be cash flow positive, but you have another need to buy it, and a DSCR loan doesn't make a lot of sense. You can buy it based on assets. So there's other things you can do to be creative within that. And last thing I'll say about DSCR loans, one of the reasons that they're popular is traditional, conventional Fannie Mae, Freddie Mac backed loans do not allow you to buy or hold title to a property in an LLC. So the agencies say it has to be in your personal name. If you were to deed it to an LLC after closing, technically you're in breach of your mortgage contract and that mortgage servicer could call your note due. But the DSCR loans do allow you to purchase property in the name of an LLC. So if that is something that's very important to you, then DSCR loans are a good option. But DSCR loans have become so popular that a lot of times people will call me, they want to buy their first rental, and they say, hey, I want a DSCR loan. Well, come to find out, we get to talking, the rates may be better on a conventional loan, and then they say, well, never mind, I'd like to go down this path. So my
Yeah.
other thing that I would say is, DSCR loans are specifically for investment properties, but they're not the only vehicle to finance investment properties. So don't necessarily get hung up on, I want a DSCR loan, but rather, what are all the options that I have to buy this property, and show me what those rates and terms look like, and then let's decide what's most favorable.
Yeah. And then going back to my original point is knowing and trusting who you're working with and in interviewing different lenders and banks to see who you feel more comfortable with and who has the knowledge, especially if you're an investor, who has the knowledge of, like you do, Daniel, of all these different options, and you can kind of trust them to guide you. You're like a financial advisor in a way, is that you trust them to be able to help you make that decision. So, yeah, absolutely. Well, thank you so much for all your help with me and my scenario. I mean, it was so incredibly helpful, and you were very accommodating and gracious and easy to work with. And I really, it's a complicated process. It can be because there's a lot of information that you're being asked, but at the end of the day, it is worth it when you're talking about an asset like this. So.
Absolutely. Well, I appreciate you having me on, and really enjoyed getting to talk about some kind of out of the box stuff. We spend so much time in the same little box talking about the same thing. So it's cool to be able to branch out and talk about things that are maybe a little creative and stuff we don't get to see all the time quite as much.
Yeah, that's great, Daniel. I'll put your contact details in the YouTube notes so everyone can get in touch with you if they're interested in learning more.
Cool. Well, sounds
Awesome.
good.
Excellent. All right. Thanks so much. You have a great
You,
day.
you got it. You do the same.
Thanks so much for joining me today. If you got something out of this video, I would love it if you could like the video and subscribe to my channel. I will have all the notes and Daniel's contact details in the show notes in YouTube. And if you're on Instagram and Facebook, I hope you'll connect with me there at Invest with Mindy. Thanks so much for joining me, and I look forward to seeing you next time.